Welcome to CFO 4.0, the future of finance. The CFO role is changing rapidly, moving from cost controller to strategic visionary. And with every change comes opportunity. We are here to help you take advantage of this transition, to win at work, drive your career forwards, and lead with confidence. Join Hannah Munro, Managing Director of ITAS, a financial transformation consultancy, as she interviews key experts to give you real-world advice and guidance on how to transform your processes, people, and data. Welcome to CFO 4.0, the future of finance.
So hello everybody and welcome to this episode of the CFO 4.0 podcast. My name is Hannah Munro and with me today is Stuart Mellis, who is the CFO of Optalysis. Now I'm really hoping I've got the pronunciation right there, Stuart, so you'll have to tell me if I haven't. But welcome to the show.
Thank you very much for having me.
So tell us a little bit about your journey to CFO, Stuart. What was your background?
Okay, so my background was after university. I actually started training as a teacher. So my first job actually was a secondary school maths teacher in Doncaster, which I did for 3 years, many years ago. But after that, I realized that lots of holiday when lots of my mates were working wasn't that much fun. And I actually wanted to get back into do a bit more study. And I actually bumped into some friends who were trained to be accountants and thought, accountants aren't quite as dull as I thought they were. So I started a training contract with a top 20 accountancy firm, and then spent 9 years in practice, which is quite a long time. But really that's because I was getting new opportunities, getting promoted. But I got to a point at kind of senior manager level where I had to decide, am I here for life or do I go and do something different? And doing something different seemed more interesting and kind of more exciting at that point. So I moved to join a food retailer. Summerfield doesn't exist anymore, but you may well remember they were a significant kind of 5 billion turnover business based out of Bristol, which is where I was living. And they were just been taken brought out by private equity owners. So it was really a kind of 4-year period of sorting out a business. So I was in the finance team, kind of group finance team. So it was sorting out processes, sorting out systems, moving to put in a new ERP system, and then getting a business ready for sale. So private equity kind of playbook, really selling the business to the cooperative group, and then spending a year integrating that business between Bristol and Manchester. So 4 years, fascinating time, met some really good people, had some really good experience, but then wanted to get into something a bit more smaller where I could have a bit more impact. So after that, I worked for a number of years in different kind of fast growing SMEs of various types, from cycling distribution to technology. And really realized that technology I was really interested in, and that was the ability to make something that was new or something that was better than what was there at the moment, and then you could really see the opportunity for growth at quite a fast rate. So my last role before coming to Optalysis was with a semiconductor manufacturer called Exmos, based out of Bristol, and helping them scale the business kind of ahead of looking for exit. And then Optalysis came knocking on my door about 15 months ago and saying, hey, we've just raised some Series A money. We're a team that's growing fast. We need some help in that scaling process. You've done that with Exmos, you've done that elsewhere. Would you come and help us as we build a company, raise more money, and take technology that's looking like it's really interesting and take it into a business?
And I'm assuming that Series A round is private equity backed as well. So you've sort of got that path, or is it taking?
Yeah, venture equity backed. So it's venture money. So we have so Optalysis has 3 main venture capital funders. One being Northern Gritstone, which is a UK regional based VC. One being IMEC Expand, which is a technology investor based out of Belgium. And then the final one being Lingotto, which is a fund of the Exor family based out of Italy. So it's a good combination of investors from very technical to very financial to very regional in terms of building a successful technology business in the UK, which I think is really interesting.
Yeah, really interesting. And we're just on the back of a series around private equity and that whole space. So, having worked with private equity obviously in a previous life and moving to more venture backed, have you noticed any distinct differences in the terms of the way that they work and their expectations?
I mean, I think whatever the kind of setup of a business, you've almost certainly got external stakeholders, whether they be venture-backed investors or private equity-backed investors, and clearly they will come in at different stages in a business. So venture will typically be more early stage, so there's kind of still technology to questions to resolve, and it may be pre-revenue or kind of early stage revenue. A private equity will be at a much later stage where there's almost certainly you can see the route to a positive cash flow position, or you are already at that kind of cash flow positive trading position. So I think, so different times in a company those investors will come in, but their needs are very similar. They want to understand how the management team are working. They want to have that KPI reporting. They want to know that you're doing all the basics well, but then also they want to be part of that strategic discussion of how do we take this business forward? How do we achieve the objectives, whatever they are, for the company over the next period? Because at the end of the day, any of these investors, they have an exit plan, whether it's disclosed or not, but they're there to raise money for and to seek returns for their investors. So it's always important to put yourself in their shoes in terms of what does good look like for them, and therefore how do we need to operate in a way that will deliver those returns.
And in your most recent role, it sounds like you've got a number of investors that you're or external stakeholders that you're working. How do you personally manage the competing demands as CFO of multiple stakeholder investors?
I mean, I think it's trying to. I mean, I think at the moment we're pretty lucky, and we're lucky because we're only 18 months into post-investment period. So
Mm.
at that point, their interests and our interests are pretty aligned. We are moving towards kind of first revenues, hopefully in 25. That's a key point for them as well. We're also looking to raise money currently. So our alignments are quite similar. I think the challenges come when you've had a longer period. So perhaps when, if you haven't quite delivered the plan as it was originally sold, and you're then in a what does plan B look like, and how do we do that? And I think, the key for me, I've always found, is it's really important, stating the obvious, but your investors need to trust you. They need to trust the management team. They need to trust your processes, but also your decision making.
Mm.
If that position of trust is there, then it's right for them to be the directors that are asking difficult questions and are saying why, and can you explain that, and can you justify that? But that's okay. That's the right that comes with their investment. But it's key that if they trust you, then they will also allow you to get on and do your job and and to make those decisions and not get into a micromanagement type situation, which is bad for everyone.
And you talked there about building trust. When you first came in to your current
Yeah.
organization, how did you work to kind of give them the comfort and set yourself up for that sort of that success with that relationship? What did you do in the interim, when you first came on board?
Yeah, so certainly. So I mean, pre-appointment, I met with all of the investors, just to kind of see what they were like. I mean, that's as much about my diligence process in deciding to take the job as anything else. But clearly, they had to. After that process, they were in a position to go, we think this guy could do the job, and we think he's trustworthy to do it. But obviously, once you start, you're then, where I was when I joined, the business was about a budget because it had been decided to hold on to it until the CFO arrived. So that budget process and that kind of explaining of this is what the next year looks like, these are the assumptions that we're taking, I think are really kind of building blocks of kind of, demonstrating how I work, demonstrating my credibility. And then, as I was going through that process, the key was to get a budget in place fairly quickly. But there were some things that I noticed during the process that we needed to change. So, kind of an accounting policy that was weird, and that had just been carried forward without really any fault. So it was that kind of credibility to say, look, this is where we are, but we're going to need to make this change and this change because of X, Y, and Z. And so I think it's demonstrating that credibility. It's communicating well. I mean, communication, you could say, is important with an investor board. You need to have the right level so they're getting enough communication, but not being drowned by lots of emails. So I think it's building that reputation, via email, via conference call, and then when you meet in person, it's kind of having those conversations and bringing that kind of logic and being, I guess, not being put off by difficult questions, because actually that's what the board are there for. And so we need to make sure that we're kind of understanding their position and providing the information that they need.
So you talked about judging the right level of communication and not bombarding them, but still making sure that they're well informed. How do you look at that judgment? What are some of the sort of the signs that you look for in terms of how you manage the cadence, really?
Yeah, I mean, in some ways it depends on where you are as a business and what type of business
Mm,
that you are. So, we're a deep tech business. We are, our technology is kind of very R&D underpinned. So, as much as I'd like to move really quickly, sometimes we can't move that quickly because it takes time to do that research and development. So a kind of weekly cadence email saying we've done this, we've done that isn't very exciting, because
mm,
well, we've moved a little bit from here to here, but it's not that, it's not that interesting. So I think you have to understand the context. So what are we doing? How do we communicate? So we at the moment communicate with our board on a monthly basis. We have a quarterly cycle of formal board meetings, but we communicate in a meeting sense on a monthly basis, and then we will probably send one or two emails in that interim period just to keep them, particularly as we're fundraising at the moment, that's probably moving slightly faster than our normal R&D. So therefore, it kind of warrants that additional frequency of communication.
And obviously, you mentioned that board cycle. When you're thinking about your board structure and your board agenda, like how do you decide as a CFO what to put on? Because board meetings can take a huge amount of time. And I actually
Yeah.
literally had this conversation with a PE house the other day, and they were saying that the agenda is critical to success. So it's my new question for everybody: how do you decide what to put on the agenda?
Yeah, so we've been through kind of, I mean, the good thing is Optalysis is relatively new to have external investors. So
Yeah.
it was a kind of reset period for what does the board meeting look like. And we've kind of evolved a little bit as well. So what we try and do now is we need to realize that our investors don't spend 24/7 on Optalysis. They've got a portfolio of companies, they've got other interests. So
Mm,
actually they are dipping in and dipping out. So we need to make sure that we enable them, we enable the board for success. So what we've moved to now is that we send out quite a detailed pack in terms of narrative of the whole areas of the business. So what have we seen from a technology point of view? What's our cash position? What's our commercial traction? How are things changing? What's our staff changes, etc., etc. So they're getting, before the board meeting, a pretty detailed update on where Optalysis is at this point in time. And
mm,
what we're finding is that's a really good way of bringing our board directors up to speed. And that's not no criticism of them. It's because actually they've been dealing with company A, company B, company C, and then Optalysis is there as well. So we're bringing them up to speed, and then we're really looking and saying, with a board, there are clearly some things that always have to go to board. So there are things that we're stipulated by our articles the board have to look at. Okay, well that's easy. Then it's about how do we get the most value from that board. So what are the pressing issues where that board insight, is going to be really important. So that will be around strategic decisions, fundraising strategy. It will be around commercial progress. What are we doing? What help do we need? So I think it's very easy in a startup business to go, the board meeting is something to get through because it's like, through this, it's a lot of work, I get through it, few have done it. I'd always encourage people to think, what do I want to get out of it? Because actually I've got really experienced people, almost certainly around my board table with multiple years of experience in different areas. What do I want to get from that? Or what does the business need from that? And how do I then kind of elicit that from them? So we found that getting our board members up to speed before they come to the meeting puts them in a better position to then help contribute to solving problems or to advising in the kind of the giving a view on what the strategy we're trying to put forward.
And that's really interesting. And I love that as an approach. So, and out of interest, when you're approaching strategic decision making in that board meeting, and you talked about getting advice, how much of it is giving an opinion on a set pre-presented options, and how much of it is sort of almost pulling out the options? What's the split that you're finding with your current situation?
I think it depends on the issue that you're looking at. So I would I would look at kind of our last board dealt with two issues. One was the commercial progress of the business, one was fundraising. So fundraising, our investors around the table, they're experts in fundraising. That's what they do every day of the week, albeit on the other side of the table. But so a lot more they can feed in, opinions about other investors, about the process, about the presentation, about how that will be received. So their input in that is quite large, and that's what you'd expect. But then from a commercial point of view, we're talking about first commercial opportunities for the business. They have a view and they can ask really good questions, but actually it's about what's the product, what's the commercial, offering. And so I think they can then ask good questions because they've been through that journey with other customers, that first commercial venture. Then their questioning, I think, is the really valuable thing there because they've seen it. But actually, I wouldn't expect them to say, well, I think that product spec is slightly wrong because of X, Y, and Z, because that's a granularity that I wouldn't expect my board of directors to have.
Yeah, so finding the balance and judging the room as well, understanding what expertise that you have within that.
Yeah, and I think then that becomes as the board develops, clearly what you want is a range of experience and expertise across that board setting. So, a board that has only investor directors on it is probably going to be less useful than the board that has some operators on it, some commercial experience on it, some who then have expertise that kind of are more broad in terms of what the company is trying to do.
And how much, out of interest, how much input, given the stage that the business is at, how much input have you had into the makeup and the balance within that board at this stage?
It's a bit of the board's important. So some of it is certain investors, their investment comes with a board seat, right? So that's fine. That's kind of, we understand that. And then it really comes down to, so for two of our investors, they, one of their kind of, they put people on from their fund, which is absolutely right. And, they were the kind of people, the partners who were leading that investment process. With one of our investors, they have looked a bit more wider because they wanted an observer seat, and they wanted to ensure that we could bring on people who are a bit more operator-like, so not venture capitalists in their kind of on their CVs, but basically they had experience in growing companies, in identifying the markets that we're looking to move into. So I think there's it's a conversation. I mean, I think I guess we'll talk about fundraising later, but a funder that's like stipulating this is the investor, this is what's coming, is a kind of there's some warning signs around that, because there needs to be a collaboration. The board's really important. There's a lot of, as a business is starting out, the board of directors is really, really essential to be working well. And the kind of director imposed by an investor sets about that wrong sense of collaboration. It's a kind of, it feels dictatorial, which I don't like.
Yeah. And you've used the words like communication and collaboration a lot when we're talking about that board relationship. How do you find the balance between supporting the CEO and making sure that you're all, that you're making the organization look good in front of their board and that we're going in the right direction, versus managing the trust piece with the investors as well, because you are that view on how the business is performing?
Yeah, and I think the credibility is important and the trust is important. I mean, so is I think there's a view of how do you present the business. So the last thing, I've seen situations in the past where presenting the business to the board has almost been like a fundraising presentation. So it becomes, you're almost setting yourself up, not necessarily for fall, but you're setting yourself up to you're setting a high challenge, and sometimes I understand why you get into that situation, but the if you're going to get value out of your board, you sometimes have to say to your board, this hasn't gone as well as we thought it was going to go, and actually we need to rethink. Our first draft one wasn't as good as we thought it would be, so we need to think about what we're going to do it again. So there needs to be a place where that trust means that you can be honest about what's working and what isn't working, so that you can get that input in. But that's quite hard, because you have to have that credibility and that trust for them not to think, oh my goodness, this management team doesn't know what they're doing. So there's clearly a kind of a line to walk. But I think it's about kind of working out as a management team before you get to the board meeting where you're at and what systems you want. I do think that the management team speaking as one voice in a board meeting is quite important, because if we've got stuff to work out, let's have that. That should be a management team discussion, not to be had in front of the board. I think that's confusing for the board, and I think that doesn't help credibility. So I would much rather build trust, be of one voice, but also be able to have the honesty to get the value from the board that you want. I mean, the reality is every board member of a startup business knows that we may get to that goal, but the way we're going to get there is unlikely to be as straight as the Series A proposition hopes it would be.
So for me, one of the most important things about any transformation project is the partners that you work with. And whilst I'd love to list off a whole host of reasons why ITAS is the perfect partner for your transformation project, why don't I let our customers do the talking for us?
One really good thing working with ITAS is it's dramatically reduced my blood pressure. Obviously, an account system is critical to anyone's business, so innovation data, without that, like every company, we couldn't function as a company. So it's one of the most critical pieces of software, and any sort of vulnerability we have with that sort of keeps you awake at night. And now working with ITAS, I don't have any concerns about our accounts functionality and our account system and the usability and all of that. Working with previous partners, I've got some grey hairs and sleepless nights from that, as I say, because it's so critical. So it's been an absolute pleasure, and long may the relationship continue.
And from a communication perspective, how much communication, you mentioned obviously a monthly update, outside of that email cadence and the regular board meetings do you actually have with your board members? Is that something that you actively seek out, or are you very much a feed of information?
I think that there's a kind of, so CEO and board members. There's quite a lot of, WhatsApp kind of conversation, questions, observations. Mine's pretty less so. I mean, I probably from coming on board slightly later. So kind of more formal around, emails or occasional texts or WhatsApps. But I would say that's more in the kind of CEO, board director kind of way of operating.
Yeah. And you mentioned obviously fundraising. So
Yeah.
tell us a little bit about your experience with fundraising. What were the lessons that you've learned over the years about how to approach it well, and maybe some of the things not to do, because that's just as important.
I mean, what have I learned? It always takes longer than you think. It's always harder than you think. And there are always going to be more no's than yeses. So
Yeah.
it's not it's a necessary part of life, but it consumes a lot of time in a startup world. You've got to be quite resilient, because you can deliver a perfect pitch and think it's blindingly obvious that this investor should invest, and then they say no. So I think it's, I don't think it's easy. I think anyone who says they love fundraising, I would question their kind of, their intelligence. I think it's hard work. At the end of the day, you are trying to raise money to grow the business. Actually, what you want to do is grow the business, and fundraising needs proper, it becomes your job in lots of ways. Because you're always working, right, how do you present the business? And as the process evolves, you need to keep looking at feedback, and need to kind of say, well, how do we change the presentation? How do we better communicate? So Optalysis is hard because we're a deep tech business trying to tackle a deep tech problem. So we've almost got, we've got a deep tech technology, but we're trying to tackle a market that is in its early stages of opening up. So we almost call it deep tech squared, because it's kind of like product being built, market being developed. It's, so there are lots of investors that aren't going to be interested in that because it's not a SaaS product. I can't see a return straight away. So I think the kind of things that I've learned is, you need to diligence your investors, or the investors that you're going to. So there's no point doing 100 presentations if 70 of those companies were never going to invest in you. So I mean, investors are getting better at kind of knocking that off themselves. But you should go, why are we investing in this? Were we doomed to failure? Because no one likes to fail more than they have to. So I think that's the key. I think the key is, you need to believe in your vision and believe in what you're doing and believe in your objective as a company. I think that's really important. If you're there as the CFO and you can't stand behind that financial slide of how revenue and cash flow are going to come in, then that's a good sign to leave the company. So you need to believe in it, and you need to set yourselves targets that you're confident of delivering. The temptation to kind of lean forward too much because that'll secure the investment. Most investors are pretty savvy to that, and even if they're not, you don't want to be in a position where you've overpromised, because that's just a horrible way to live for the next 12 to 24 months. So you've got to find a way, and it's hard, and it'll be different for every opportunity, of how do I explain the proposition in a way that gets the excitement of the investor. So for us, we have to find people who go, wow, your photonics technology is amazing. We can see what it's going to do. We really understand that the FHE, fully homomorphic encryption market, we can see that's going to be massive. So we can buy in the two, then you've got massive potential. But then we have to also go, because some investors will say, great, big picture, but what about now? We've then got to be grounded to say, actually, we need to talk about commercial stuff now. And when does revenue start, and how can we do that? So I think you've got to get your pitch right. You've got to work really hard to get your pitch right. You've got to understand your investors that you're pitching to, what really matters to them. And, I think we do have to recognize, whether we like it or not, UK companies pitching to UK European investors, it's slightly different than being, if you're a US company, knocking on the doors in Silicon Valley.
Yeah. Yeah, there's been quite a few conversations at the moment, I think, going on about that difference in funding and investment with the UK versus the US, and that's an interesting dynamic. And have you seen that dynamic playing out in terms of, have you worked with with US based capital investment
Yeah,
versus UK, and have you felt it?
yeah. I mean, I think I think it's, I mean, I think the reality is a US firm looking to invest in the UK probably has, slightly higher bar requirements because
Mm,
you go, okay, there's an FX risk there. I've got to jump on a plane to the UK. So there are hassle factors. Now, none of those are things that will necessarily stop an investment, but they just kind of make the bar slightly higher than if you were saying, "Hey, I'm just down the road in San Francisco. I'm in the Valley. We can, it's just easier to
yeah,
invest closer to home." So I mean, I think the reality is that um, we do see in the investors we're talking to in Europe, they are, they are keen on, you know, commercials, and when do we see commercial traction and how do we de-risk that? So I think that is a difference. So it's kind of getting the right story, the right message, and I mean, at the end of the day, you know, an investor is looking at product, it's looking at market size, looking at team, and you have to demonstrate that you've got those, and the opportunity is significant, and you can deliver it. So it's yeah, it's one of those challenges that will always be there.
yeah. Whether it's a UK or US, the proposition has to be right, and
I
that's
mean,
critical.
at the end of the day, investors are smart one way or the other,
Mm.
and they will. You have to tick those boxes, and if you don't have those things fully addressed, then you don't have a chance.
And so, from your perspective, how do you approach the budgeting process? Bearing in mind, obviously, you've got to make the investment exciting enough that people
Yeah.
see that there's value and they want to get involved, and also being mindful of the fact that you need to you're going to be responsible potentially for delivering on that number. So, is there any secret to finding the balance? That you discovered.
I mean, you've got to. At the end of the day, you've got to live behind it. You've got to stand behind it. So
Yeah.
you have to you have to be able to explain financially what this investment produces. So
Mhm.
we will focus a lot on, so a lot of our investment will be on chip development, so either digital chip development or photonics chip development. So that's, we can explain what that's for, what that's achieving, what that will achieve. The budgeting for that is relatively easy because it's a cost basis. We understand what's happening. The challenge with any company is, what does the revenue look like, and when does
Mm.
revenue happen? So you could stand back and say, look, we haven't got any revenue today. We are in that product definition phase. So we don't, at this point, do we know what the product is? Therefore, can we price that product? Can we work at the gross margin? So that there are lots of uncertainties. Um, and, but you have to make some assumptions. And actually, that's what, at an early stage where you haven't got revenue in your business, where you haven't got products that are rolling off the shelves, at this point, you have to make those assumptions. Now, those assumptions may be wrong, okay? And I think investors understand that. They understand that you've made some assumptions. They'll look in the diligence process at what are those assumptions? Do they seem sensible? And then, most investors in early stage will realize that, you know, plans may change. They may change, because you've accelerated something, you've realized something you could sell for cheaper or more expensive or whatever. There are multiple reasons. Um, so you have to, but it comes back then to that communication process. So when you've had a budget, you've made some assumptions. Lo and behold, the budget is wrong the minute after it's finished. But then it's about how you explain the variances. So I don't think having variances in a budget is necessarily a bad thing. The bad thing is having variances that you can't explain, and that's when investors go, well, we're not sure we can trust you. We don't know your ability to report your numbers is very poor. and that creates all kinds of problems. I think if you're in the situation where we made this assumption here, actually 3 months down the line we realized that assumption was wrong, but it was made with the best knowledge available at that time, then an investor will understand that, because actually, as long as you can then say, but this is where we are now, and this is what we're going to do. So I think you don't have a crystal ball. There's no way I can make a financial assessment for 2 years' time. I don't have a product at the moment. So and most sophisticated investors will understand that.
And it sounds like you've got two challenges. Firstly, it's like emerging tech, so the product hasn't yet been defined, but also that you're working in what is an emerging market as well.
Yeah.
So
Great.
how do you deal with that piece as well? Like almost sizing the market when it's not emerged and it's not well defined.
Yeah, I mean it's so you're trying to learn. You always worry that you're slightly one step behind, because you're always wanting to know more than you know at that time. So what you're looking for is we have identified what we think is our first market, and we identified that kind of, I guess, as we built our understanding of what our technology could offer. And then we started talking to customers. So the challenge for a startup, particularly a deep tech startup, is that you start building your chip or your product, but you're doing it based on your best guesses. I mean, hopefully they're intelligent guesses and they're sensible, but you don't at that point, at the early stage, have that kind of customer feedback that becomes part of that product development process when you're slightly more mature. So we are now in conversations with customers, or with people who could be our first customers. And so we're getting that feedback about what is it that the product has to do in a granularity level that we haven't had before. So that means that we have to hear that, and then that goes into a kind of refinement loop of, that's what we need our product to do. That's how we do it. So you have to be sitting in this world. You have to be prepared to deal with uncertainty, and not as a kind of, oh my goodness, it's uncertain. Well, it's uncertain because it is uncertain, and that's okay. But then you need to push. So for me, it's working with my teams, commercial teams, technical teams, product teams, to go, right, when do we have that information? How quickly can we get it? How solid is it? And what assumptions do we need to update as a result? So it's kind of, we're in an iterative process, and that's where you challenge your organization to be ensuring that teams are working well, cross teams are working well, and that we're asking the right questions of our customers.
And we talked a lot about the fact the uncertainty that you are experiencing, but you've also mentioned sort of the need for a path to profit, and this is coming up a lot more in certainly the conversations I'm and some of my customers are having with their investors. Is how do they get to that route faster? So as an emerging tech within an emerging market, how do you balance the need, the path to profit and extending that runway? How do you approach it?
I mean, I guess you look at the, any CFO. Well, sorry to put words in the CFO's mouth, but my personal view is, the sooner I can get to being cash flow positive, the better. Okay, that's my kind of starting off, without anything else coming in there, because at that point I get control of my destiny. I'm making cash. I can decide what I do with it. So that's clearly where you want to get to, but the road to getting there, will have different lengths depending on the type of market and what product you're trying to sell. So we know that because the level of capex type expenditure we have to do is high, that we can't hit that point for a number of years. Okay, so but what we have to do is then raise money to do that capital expenditure. So basically, we have to be able to fund the development of chips, and which become our products in one form or another. And then, so we need to raise the money that builds that process out. And then, as soon as possible after that, we have an operating business, the selling of chip products, that becomes, cash flow positive. So there is a sense of, yes, I want to be cash flow positive as quickly as possible. Then the interim step is, well, if I've got to do some big capex which challenges that first assumption, then I need to raise money that will fund that. And then how quickly after that can I fund an operating business which is cash flow positive? So there are different steps. Operating business, that's selling, buying of stuff, selling it, employing all the people. Can I make that model cash flow positive? And then how do I then build on top of that what will always be a significant capital expenditure focus that I need to fund as well? So, I think it's then about understanding and helping your investors understand that journey. So, if you looked at us and say, well, there's no way you're going to be cash flow positive for years. But if I say, look, but if I can do this, then this bit's cash flow positive, and then I'm just funding for the capital bit.
And given that what you're doing is emerging tech, how do you figure out the cost to getting to a point where you've got something that's sellable as a product? So how do you assess that, and what's some of the variables that you look at?
Well, I mean, so I think you've got two elements there. A is pricing. So what is it that you're selling, and what's the value of that? Now, clearly, we are in an emerging tech space, so our pricing model isn't going to be, we're not going to go cost plus, because actually I don't want the cost to be defining what my price is. If I'm giving value to customers in a new way, that has a value proposition to it. Clearly, from a cost point of view, we once we know what our bill of materials is, then it's then a question on, how do we manufacture that, or get other people to manufacture it for us, so that bill of materials is as low as possible. Now, I have a kind of rule of thumb, and that's based on kind of years in semiconductors. The market for listed semiconductor manufacturers usually says, if your gross margin is 60% or above, you're a good semiconductor company. If you're below 60%, you're less interesting. So, we are still working on what our bill of materials will be. We're still working on our pricing strategy, but as a kind of starter for 10, I don't want to be less than 60% in terms of that gross margin. So there are some rules in my head, but we need to do the detail to work out where we land.
And what about the R&D costs? How do you assess how long you're going to need to actually get to that point where you've got the sort of the finished product? Is there a rule of thumb, like you say, a benchmark within your industry, or?
Not necessarily. I mean, there will be a kind of rule of thumb around ongoing R&D spend, but we're not at that point where we've got an established revenue line that will kind of do that ratio in a sensible way. I mean, I think the key is a product roadmap, or a technology roadmap, because then it's saying, this is what we're going to do when, because that's the fundamental that should excite any investor. You're saying, right, this is where we are today, this is what we can do today, but these are the steps that we're building to. Now, we, as you'd expect, we employ, experienced chip manufacturers and designers. So they have a pretty good idea of what the costs attached to that are. But there are variables in it. So, we'll be building a chip that's a 12 nanometer chip at the moment. Now, if someone turns around and says, actually, it needs to be a 7 nanometer chip, then the cost multiply, significantly. So, there will always be, it's hard to make a hard and fast rule, because we are doing something that no one's ever done before, and we're trying to do it better and faster. So for us, it's around, can we, we have an amount that we're trying to raise. Can we raise that amount? If we can raise that amount, we can deliver the plan in the timeline that we're looking at. If we raise a smaller amount, well, we'll do it slower. So there's theoretic kind of ways of working, and there's practical ways of working. And if I can raise this much, then I can go this speed, and then I'll need to raise again in X years or months or whatever.
And as a CFO working in deep tech, how much do you think you need to know about the technology that you're working with in order to do a good job? Like, is there a rule? Is there any sort of level where you go, right, I can't get beyond that? Or do you personally really invest in understanding it?
Okay, I mean, the way I operate is I like saying I'm the least intelligent person in this room. So 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 we employ people with PhDs, with masters, with they talk in a language I need to translate. So, and I'm in some ways, I need to understand the technology. I don't need to understand everything about the technology, but I need to understand the key characteristics of it, the key challenges of it, the key tasks that we're undertaking. I don't want to be, a pseudo engineer. I'm not an engineer. That's not my background. But I want to know enough to be able to ask the right questions, because engineers love solving problems, which is amazing. That's what we employ engineers to do. But I want to make sure that they're solving the right problems for us as a company. So if I can solve the problem that's going to yield us revenue, then that's a much better problem to solve than one that's just a technical challenge. So that's my view is I guess I play the persona of tell me why we should do this. Tell me why it's valuable. I've always liked that place, because also I never like people who try and pretend they're smarter than they are. So most people are more intelligent than me, and I'm quite happy to ask stupid questions. So I mean, that's one of the things I take with me. When I left my last role, one of my staff said to me, when I came to this company, I thought that asking questions was a weakness. And he said, but actually working with you has taught me that that's not the case, and it's actually the opposite. So I would, my biggest piece of advice for anyone is ask questions. Don't be afraid that a question is stupid, because it probably isn't. It may be, but actually that doesn't matter, because in asking a number of questions, there'll almost certainly be something that's really valuable.
Yeah, having the courage, I think, sometimes to ask
Yeah,
questions when nobody else is
yeah,
the
and that's
hallmarks of a good
definitely.
leader.
Yeah, and I think that's and so kind of enabling your team, or encouraging your team, or giving them permission to to ask those questions, and it's how you respond to a question, isn't it? If a leader gets asked a question, if you're like, that's an excellent question, that's a brilliant question, thank you for that, I hadn't thought about that, or whatever, then you just encourage that behavior to continue.
And so, because I could pick your brains all afternoon, Stuart, and I promise I won't. But if you had to give some advice to a new CFO, or a CFO that's never been through a fundraising or debt raising round, how would what top advice would you give to them?
Okay, if you're a new CFO coming to role, what I would suggest you do, and I would talk to your CEO, and I'd say, actually get a coach. So I used a coach for 2 years when I was at Exmos, and it was brilliant, just because you can go, I've just got this situation, I haven't come across it before. What do you think? I'm thinking about doing this. Does it make sense? And I think we're very, yeah, I think a coaching situation can work really well in just helping you get that because when you become a CFO, you report to a CEO. It's not, it may well be the first time in your life you've never reported to a finance person as a line manager. And so
Yeah.
CEO thinks completely differently from a CFO generally. And it's important to understand that. So I would, my advice beyond that would be, look, get to know your CEO. The CEO CFO relationship is absolutely fundamental. You need to understand where they're at, what their risk profile, what they see as risk, what they don't. You need to make sure that what their integrity levels are like, because as CFO, at the end of the day, you're responsible for making sure that the resources of the company are being used properly and right and accountable and controlled, etc. So I would that's the CEO relationship is really, really important. So invest time in that, and really push that. And then it is just, my sense is, first of all, don't believe that I guess it's that kind of fear of someone's going to find me out. I'm not actually up to this role. If you've been promoted to CFO, you're almost certainly up for the job, or you've got the skills that can make you into a good CFO. So be kind of confident. Don't be humble, but don't kind of put yourself down. And then, then ask those questions. Your CFO will work with loads of advisors in different situations, and advisors like to give a good impression, and many of them are very, very good. But sometimes you can be a bit scared to say, what does that acronym mean? I don't know what that means. And so I would just say, don't be afraid to ask questions. It's not a sign of weakness. It's actually the opposite. And then just be confident that if you've got to CFO level, you've gained experience which you didn't think was very interesting or very useful, but it will be. That's my experience has been as I've moved from Exmos to Optalysis. There's loads of stuff that I did at Exmos that is now really relevant as we think about what we do here. So don't forget what you've done in the past, because actually it's often, for good or for bad, very useful.
And if and I have to say, I think just listening to your story and the things that you've learned over the years, and also it's super interesting to understand almost the challenges that you're facing in with emerging tech and emerging market. That's a really interesting space to be in. If people want to learn more about the organization, Optalysis, and what you do and where you're going, where is the best place to find you guys?
So optalysis.com will take you to our website. It should be easy enough to follow, but it will give you a kind of insight into what we're trying to do around photonics, around solving the acceleration issue for FHE. I'm on LinkedIn, so Stuart Mellis. If you search under Optalysis Stuart Mellis, you'll find me. So happy to have conversations there. So any questions, very happy to take.
And thank you so much, Stuart, for sharing your journey with us. And if you've enjoyed this episode, you'd like more, or perhaps there's a question I should have asked that I didn't get round to, then please do reach out to me as well, direct on LinkedIn. Is probably the easiest place, but you can always grab me on the podcast email on the website, www.itassolutions.co.uk. Well, thank you again, Stuart, for joining me today. And thank you to our listeners. And we'll see you next time on the CFO 4.0 podcast.
Now, for the £1 million question. What is the best finance software for your business? Is it A, Sage 50? Is it B, Sage 200 Standard? C, Sage 200 Professional? Or D, Sage Intact? An impossible question to answer without a lifeline. But we have the perfect lifeline for you. Our free quiz, Which Sage Product is Right for You, will tell you which product is the best fit for your business in just 5 minutes. All you need to do is head to www.itassolutions.co.uk and answer a few simple questions.